there was a very interesting literature back in the 1980s, and the late, great William Baumol contributed to this. And it was this famous book by Baumol, Panzer, and Willig. And this was when there was the whole deregulation of the airline space that was going on in the United States. And so there's this whole literature on contestable markets. And contestable markets being markets where firms had a certain amount of monopoly power, so they had market power, but there was a competitive fringe. And basically the competitive fringe, in terms of potential entrants, was what was keeping the potential monopolists and the firms with market power at bay in terms of their behavior. And it was a very interesting literature because it led to a development of a whole new section of a whole new corpus of microeconomic theory, because basically, given that they were looking at airline markets, this was multi-product. This was basically multi-product. They were the first people, Baumol, Panzer, and Willig, the first people to look at multi-product cost functions and things like that, because each product was a route, right? So a route, an airline route, and I just wondered, what kind? And again, I'm not. This is an open question. What kind of market structure, as economists, what kind of model should we have in mind? Is it contestable markets? Is it monopolistic competition? Is it, oligopoly based on price? Is it oligopoly based on quantity? I mean, how do you think, given your experience in this field, what are your thoughts on how economists should be thinking about this?
So, airlines are very complicated entities, and the market is, there's a very high capital cost, and planes are expensive. Airports take money to build, and so when you think of these things, some of these things you take as a given. But when you're looking at the more digital market, so if you think of UPI, initially the idea was that you would have small tech companies build the front ends that people use to participate in UPI. And the regulator, in their wisdom, said, no, that requires somebody who can bear liability, something we haven't thought about, and hence it should only be banks. And then the banks said, well, we don't have the tech capabilities to bring in the users. Our net banking apps have embarrassingly low usage. So we will partner with the tech companies. We'll take the liability, but we'll bring in the tech companies to build the markets. And that resulted in, and some well-funded startups joined this fray, and now they're no longer startups. But the point being that it did result in an oligopoly, primarily because there were very few tech companies who ended up playing the front end on the consumer side. But then on the other side, the merchant side, I think there's a thriving market. Nobody talks about that. But there is a thriving market in terms of people acquiring merchants into the ecosystem. And so I do think that the airline model is not correct because of the very high capital costs in there. Here the costs are in terms of user acquisition costs and transaction costs. And sometimes those user acquisition costs are very high. And that actually reduces the competition on one side of it, but perhaps not on the other side. And so and we have, with ONDC, we've tried to move to a very different model where you kind of made it more democratic, and how to bring in people and users and merchants, and as well as the delivery ecosystem. So it's complex in a very different way, because suddenly geography becomes important, which is not as important in payments. So I think we are now, I think we're kind of tending towards low entry barriers. Occasionally there's a regulatory barrier to entry, and maybe the regulation comes later when the market becomes more developed. So we saw that with the payment players, was that RBI actually created a new set of entities in this market based on how it was developing to regulate some of those endpoints to make sure that there are more controls in place. So we have seen that become the entry barrier now, which wasn't the case earlier. So I do expect to see this play, but broadly with digital systems, we're seeing lower entry costs and lower operational costs, and as a result, a different market structure.
With your permission, I know we're supposed to sort of do just the two of us, but it strikes me that this might be a good time also to, if anyone has something that they want to.
No, great. I mean, this is a community of builders and people who study these things, so would love to hear that.
Market structure, anyone?
So one of the key things, one of the key definitions of contestable markets, it's nice that you bring in contestable markets here, is that there are not only low entry costs but also low exit costs, and there's a potential for hit and run strategies. A lot of our DPI actually leverages on the public raise that we so far build, and it's exceedingly difficult for someone to even attempt a hit and run here. Exit costs are very, very high. Even though we end up reducing the entry barriers, exit costs are very high, and given that exit costs are very high, it's very unlikely that we will be able to get someone to do hit and run. The oligopolies will continue to, in that sense, exist. Unlike the American, this one, even when the oligopolies exist, the monopoly prices didn't happen because there's a threat of a hit and run always. The threat of a hit and run will never ever happen when there are no exit, when there are very high exit barriers in public infrastructures. So, to me, the ONDC example, at least in terms of seller onboarding or even the UPI merchant onboarding example, again, there are exit barriers aren't zero. Exit barriers are very high. The seller signs up to a seller app primarily because the seller app provides differentiated services to me. I'm not digitally capable. It's the seller app which is providing me those. So there's a lot of loyalty, a lot of times. Exit barriers are very high.
I just want to add, in terms of market structure and the, different options to talk about. I wonder whether there is no one single answer, because it's also a variable of what market or segment you're talking about, how big and diverse that market is from the actual value creation perspective, and what type of player you're talking about. Because when you're talking about the example, Sanjay, you gave about that technology provider in UPI, the cost of exit from an impact perspective of the consumer is also, have to be kept in mind. And the unit economics, require you to have a certain volume versus a retail use case where ONDC like, DPI may enable, where the diversity of the user, the diversity of the needs, by design require fragmented market play.
Actually, I would question that a little bit for both of you, because when we were designing UPI, our implicit assumption was that each user would have one app. But in the first few years, you saw, people had everything. They had PhonePe, they had Bheem, they had Google Pay, they had Paytm, and Uber was putting the NPCI library into the Uber app so that they could become a service provider, and nobody complained, and people were happily going around and doing it. And so, I would question your exit cost hypothesis, because if I have PhonePe and Google Pay, my cost of exit is zero, right? And I always have Bheem. And so I would question the exit costs for both UPI and so on, because there's enough service providers. If one exit, Paytm went away, nobody cared, right? It's just that point I think we should take into account. So I would question it, but I think from a research perspective, I think we have a plethora of data here. I think, to me, there are I'm sure there'll be folks who want to dive into it and understand this better. And when you want to take a payment system outside India to another part of the world, perhaps understanding how that market should be structured, those regulators would love to see the difference based on the data that we have here. Saying that if they're building a market for a new instant payment system, how should they think about it? I think that would be very useful guidance. So I do think it's an important research problem, but yeah.
So thank you. On the market structure, good points which have triggered some thought here is about contestability. So DPI introduces contestability by design, as we all know, through shared modular infrastructure. governed by open standards and interoperable design, which creates a kind of a neutral backbone on which private innovation can thrive without creating the or replicating the gated ecosystems of a proprietary system. Having said that, there is a great amount of increasing returns to scale when it comes to the infrastructure layer. So we have to break this down when we are talking about market structure of the infrastructure layer, market structures of the applications and the private plug-and-play operators on account of the open systems. What is the kind of market structures developing there? Market structures also could be impacted due to the procurement practices of the government for the infrastructure layer. So how is the procurement being done? Is the procurement practices open? Is there sufficient competition for the market in these procurement practices of the government? So there is a risk, and we have seen that there may be conditions or situations, say for instance, the very fact that UPI, the private actors were not charging any merchant discount rates, but as we know, there's nothing free, there's no free lunch in economics, so how are they monetizing the fact that they were on the, I'm not even now talking about the infrastructure layer, now I'm talking about the application layer, how are they monetizing, because the monetization came through the data feedback loops again. So we are back to the erstwhile private digital ecosystems where then data gets monetized. And so therefore countries and governments have to be very, very clear about how and what standards they want to impose on these private actors when it comes to data usage. Because is there a risk that public infrastructure is being then monetized by these private actors and is just entrenching their data hegemony? So this is one point which I think we should be thinking about. Yes, the infrastructure can be thought about as public utilities through the creation of these national information utilities, example being the NPCI. And the network nature of these two-sided markets would endogenously, there is some endogeneity in the sense they would result in monopolies. But one needs to be careful about the private ecosystem which is developing across. Is it leading to, again, decentralizing of some market concentration? What are the solutions? What are the regulatory solutions? And what are the regulatory options? Because then we are back to your initial remarks on competition by design. So if these digital public infrastructures, are they leading to market structures such are competitive? If not, then we need some kind of a regulation, and antitrust guides us in this area.
Actually, I was reminded of a point that you made there, is that when the internet came about, people thought information was going to be free and they're all going to benefit from free information worldwide. But there's no monetization. So the only monetization that came in was essentially the attention economy. And it was ads. And that led to the attention economy, which led to polarization, because that's how you get more money out of ads. And you get disinformation. So you started from a point of information, but because you didn't have a market structure, one came on. And that then resulted in where we are today. And I was asked the question of how do we think about preventing that in DPI? And that was a question I didn't have a good answer to. But we'd love to understand more of how that's going to play out.
I have a small question to both of you. I'm from Bangladesh, and definitely in comparison to India, when it comes to DPI, we are still lagging, and then there are many issues related to regulatory issues in the market structure, the way you have presented both of you, I think very relevant for us. One small question is that how do you see the role of the foreign investment or the foreign players, especially when it comes to impacting on the market structure, as well as what kind of regulatory issues need to be taken into account? We know that there are some sensitivity of the data and national interest as well. How, given your experience in India, what were the issues came out strongly? Thank you.
Actually,
I would put it back to the research community to answer those questions, because end of the day, those are very important questions for the regulator to think about. We should be guided by the data, and that's actually part of the benefit of having this thing, is to sort of make sure that we have people who think about these issues and are able to do research to understand these implications. And so, my personal preference is to still keep markets open at the beginning, and then as risks develop, step in. If you see data misuse, you step in then, as opposed to a priori prevent the market from developing. And so, really antitrust comes when players start to become more dominant, as opposed to on day zero. But national strategic issues typically come before. And so, it's a different angle to it. But I think the idea is to have rich questions to be answered.
Can I just disagree with you on that statement?
Sure.
On the antitrust only comes, so in a previous life I lived in Brazil, and they privatized the telephone system it was in the mid to late 1990s. And they privatized it, and they did not have the antitrust regulation in place. Within 3 months, there were the equivalent of $500 million fines, because when you let a fox into a chicken coop, feathers will fly. So I'm not sure if I see where you're coming from. I just wanted to give an example where they really screwed up big time by not having the regulatory framework in place when they did the privatization. But maybe it's because what you're thinking of is a situation which is much more progressive in terms of the rollout, and it wasn't like a bang situation where you just sort of go from public ownership to private ownership overnight.
Yeah, I'm thinking of new markets as opposed to a market suddenly changing structure, where it's a large market to change structure. But here is a market which is evolving, it's starting from nascent stage, and you do need to give it time to develop before you clamp down. So, but back to the audiences.
Yeah, so I just wanted to I think when we talk of economics of DPI, we are actually speaking about the structures of the markets and frameworks and everything else also now being under question, because it's not a very standard economic thing. I'd like you to rethink this whole thing about DPI in terms of the banks were initially saying, hey Sanjay, put your salary with me, I'll keep the balances, I'll give you a debit card, a credit card, an online banking, a checkbook and everything else to spend money on. I held the funds and I helped you move the funds. In today's structure, the banks still hold the funds, but they no longer are the cog which moves the funds. It's other private entities. It's a Google Pays of the world, or the Paytms of the world, or the Phone Pays of the world, who allowed you to do that. So that structure itself now has changed. Now, does that mean that the regulation need to change from entity-based regulation to activity-based regulation? That is the question. So that's one part of the story. The other part of the story is that just because this is happening, there is an economic impact of the activities on the ground. So if you talk to the old card networks, they would tell you onboarding a merchant cost about $400 odd for each merchant, which is a reason for years India had about 150,000 odd merchants in the country because it was expensive. Today the onboarding cost has dropped down to about $2 to about $5, and we've got about some 660 million QR codes in the country today that are static, and some millions of them are being extinguished and created every day on delivery form. That changes the entire ecosystem. How do we think about the ecosystem and the framework in that instant? The other element is that we keep talking about the MDRs in the older world. Nobody is asking a question saying what have been the savings accrued to the institution if these DPIs have been in place, right? So as an example, if you move from a teller to an ATM, and you said, hey, we reduce cost. Now you're saying that here's a customer who was able to do this on his own or her own. What is the further reduction in cost that you're able to do? And is therefore, what is the overall cost, and is that able to pay for your ongoing increments and innovations in the ecosystem? So it changes the entire framework on which we guys are still thinking of in terms of the older economics. And I by training, on economics side, also did my undergrad in economics, unfortunately. So, it just needs a rethink, not on a standard kind of a framework, but I think there's an opportunity to rethink this entirely newly.
Actually, Pawan, let me ask a slightly different question. And it's, you're very much on the right track. It comes down to, like, when the banks started to put ATMs in place, they then, RBI initially allowed, a certain number of free transactions, and they enforced interoperability. And banks have been complaining about that cost, while, they're not talking about the benefit they get from reduced teller usage. And part of it is because that has not been studied enough, right? There's not been anything to say that by adding an ATM, is there a net positive to the bank in terms of customer satisfaction, more accounts?
And by the way, this continues to be a William Baumol love-in, because that was the Baumol-Tobin transactions demand for money model, going to the teller or going to the ATM. Sorry.
No, but the thing is this, what Pawan highlighted was that we went from, I actually remember a slightly different number, because I started looking at the data later than you, Pawan. I remember in around 2014-15, we had 1 million POS machines in the country. And POS machines are like cockroaches, there's one, there's more. So that's probably about 300,000 or less merchants who had POS machines in 2014. And we had 25 million cards, and again, 25 million cards is probably 6 million families with credit cards. There's credit cards, not debit cards. And so, and you had 200,000 ATMs. Now the number of cards has gone up, the number of POS machines has gone up. RBI tracks this data, it's available monthly since at least 2006. And number of ATMs has not gone up. It's still 200,000. And but the amount of cash in the economy has gone up.
Actually, it's actually declining.
Yeah, it's declined. So it's kind of interesting that for a 1.2 billion or 1.4 billion people, we still have only 200,000 ATMs in the country. And so, but our cash usage has gone up. I mean, the cash in the economy has gone up. So very interesting data sets out there. But the thing I wanted to point out was that the balance sheet of banks still reflects ATMs as a cost. It still reflects UPI transactions as a cost, as opposed to a customer retention or a way of actually bringing in more deposits into the bank. And that's actually why these studies are important, because banks constantly cry about these costs, and we need to be able to tell them, no, you're actually benefiting from this. And that's the reason why you are in the ecosystem. Shankar and then.
A fascinating discussion. Reflecting on what Pawan and the earlier discussions that happened, what is the other extreme of DPI? Physical, private, solution. Digital public infrastructure. The other end of the scale is physical, private, solution. Now, economics has mastered that, right? That word. But as we're shifting to digital public infrastructure, a lot of the underlying ground is shifting. A digital society is not a physical society with digital devices. Transactions are being reimagined, we are seeing that. So the thought for me was, what changes, what stays the same? What stays the same might be easier. We need institutions, we need service providers to have liability, we need to think of welfare and profit. What changes? Pawan's thought of, do we regulate entities or do we regulate transactions? Because the underlying ground has shifted from physical to digital. Institutions were built for physical. We think of services as solutions, not as infrastructure. The core of infrastructure thinking is, I'm providing a capability for others to build on. The whole public services, private innovation is, I choose to offer Aadhaar as a capability for others and not as a point solution within my closed system. I think the opportunity in front of us, I'm reframing the challenge as an opportunity for the community, given what you said, Sanjay, leadership position, etc., is to keep things extremely simple. We want to increase participation of citizens in the economy. We want to somehow reduce the entry barriers so that more service providers come in, right? How do we do it without them not bearing liability? That's a different thing. So we want to increase participation. The success of financial inclusion and all is just that. More people in it. We also, the point about monopoly, we want to have a churn of services and products. We want innovation. And the nature of digital is it encourages and reduces innovation cost, and therefore more products can come in. How do we play to that rather than be paralyzed by new services coming, not knowing how to regulate it? And the point of Rajini, all of this we'll miss the point if we don't go back to the story of Rajini in financial inclusion or a Ram from Aadhaar, right? Because when so many diverse players have to come together as society is changing, technology, economics, public sector, law, as all of them are coming, what is that underlying language? Everybody will not know economics, everybody will not know technology, everybody will not know policy, but everybody will know that finally the Ram, Rajni, whoever, they have to benefit. You have to assume inclusion and also opportunity. So the need to anchor it on a simple user story, use cases, citizen story, anchor it on some simple metrics, right? That to me is the quest we must have, so that we are not just predicting the past, but through this we are setting up guidelines for what the future could be, the perverse incentive, etc. So I think it's a very important initiative. It's very, very complex. In the last 15 years of dealing in this, to me the closest example is 6 blind people and the elephant, right? You talk to 5 people about DPI, we'll have 5 different things. So, yeah, just some opening thoughts.
No, I'm just asking a question. How you want to look at? Go ahead.
Can I just make some and very fascinating discussions, particularly on the sort of digital public infrastructure and the physical private solutions that you gave, 2 extremes, and sort of the cost savings versus the cost of doing DPI. So I think I just wanted to sort of come in here and we pull back, perhaps add some provocation to think about some of the fundamental questions that, okay, these are 2 extremes, but is there something in between? Are there ways to regulate and use public resources in a manner in which we can address the market failure, through which more efficiencies can be generated? So the question is that while we are all assuming that DPI is good, and we are all assuming that DPIs can result in cost savings, and therefore there is a need to pull all more merchants and more sort of consumers in the DPI ecosystem, but we are also seeing when we look at UPI or now credit, that there have been a lot of concerns. There have been a lot of exclusion issues. There have been a lot of sort of small firms not being able to integrate, or there have been concerns with respect to specific set of entities being given preference on DPIs and sort of for different reasons, so maybe stability, security, safety, etc., etc. And as a result of which, some market players may have been lost out, and therefore, and some exclusion concerns, some people might not be able to use or get benefited from DPI. And the other question is that, okay, the existing regulatory governance infrastructure frameworks were not good. The other extreme of DPI is absolutely bad. But all the resources that you had put together to sort of create a DPI, is there a way to sort of think about alternates to DPI and sort of compare DPI with, is there a better way to sort of use the same resources to achieve the market outcomes in a more sort of market-friendly manner? And is that research sort of, is that a valid research question? Is that research required? And is it happening? Because we have to look at the other side also, and a lot of these access, competition, cost issues which come on when we look at lived experience of merchants, sellers, consumers, etc.
Sure. I'm not a researcher. I
do want to give the mic to the gentleman in the back, but I want to sort of point out that while the resources have been put into DPI, a lot of it has come from the market players themselves. So if you think of UPI development, and NPCI put some money into building up their infrastructure, but the banks paid for their participation in there. The front-end apps paid for their own participation, and the merchant acquirers paid for their own. So if you want to take the cost of UPIs, all of those together, it was not directed from a central source, right? It was each player coming in with their own thing. So good to see what the alternatives are, and I'm sure somebody in the research community would be happy to think about it. But I would like to point out that people came in because they saw a reason to come in, and forced participation is, I generally am against it. But you raise that question: do you have to participate because the market, everybody is doing it, so I have to do it, versus authority saying no, you have to do it? I think they are different questions. Gentlemen.
Yeah, my question is very similar to what is being discussed. That's why I was keeping quiet. But the thing is that I think we have to ask the following question: that if the DPI wasn't done, right? If let's take UPI because that's a live example. If the UPI wasn't done, would there be a private sector solution? And the Paytm was already doing that. Paytm came before UPI. So how would Paytm have developed? Because I have seen countries where people have stopped using cash without there being any rules, regulations made about not using cash, right? Where businesses themselves move to digital payments. I've gone to shops and been unable to pay as a foreigner, as a visitor, because I was carrying cash and the shops won't take cash. So these things have happened without any rules and regulations. So I think the question to ask is, if we do not have these DPIs, how would the economy evolve? I think that's a question we need to ask, because otherwise we cannot answer the question about what would be the cost of what we're doing. There is an accounting cost, but there is an opportunity cost, right? Could we have developed a different outcome, which would have been, could have been worse, I don't know, but I'm saying that that question needs to be answered.
I have to go after this one. So I had a team working on the economic impact of DPI for a year. You may find it funny or you may find it scary. We could find zero impact on the economy. There are many studies that try to measure the expanse of DPI. So they look at many things and then they will say, so this proportion of the economy essentially is dependent on DPI and so on. But actually, when you do an econometric study, with whatever data that's available, you find no impact. So now what's really happening here? You could either be defining it wrongly. That gets to the first question, which is related to what you said. Digital public infrastructure, public what? Publicly provided or for the public? Is it public infrastructure or is it provided by the public? It's a very important question. Across India today, we assume this is essentially state-controlled entities that are involved, that are controlling the satellite here. So anyone like a Google, a Gmail, or a Google Maps is not a part of DPI. And that's essentially because we are defining it in our minds. I mean, it's never been formally defined, but we are defining it as publicly provided, not for the necessarily for the public. So I think it may be that what we were doing was that we were looking at proxies for publicly provided, and we were not really looking at the larger animal, because the real impact is happening from the economy. That's one. So that's probably one issue. The second issue is essentially that the data that you want, 6 years, so probably 7 years of data you typically get. It's very difficult to get impacts, especially because a lot of this data by the same entities are not available, let's say at the state level, at the city level, etc. You want granularity, you want spreads in data. It's a data conversation that I think. But going back to the first point, and I think this is really critical for us. Going ahead, you're going to get protocols which may come up spontaneously. With AI, it's very likely that you will have spontaneous protocols where people start to collaborate, or mechanisms start to collaborate. Would they be a part of DPI? I think most people would agree that they would be. But right now they're not. So I think we need to really rethink this concept of DPI. It should be for the public, not necessarily public provided.
I don't want to answer questions. I want to raise questions. Right? I'm happy questions are being raised and ideas are being generated. So I'm happy with that thought. And I mean, it'd be good to know if there's no impact. Right? I mean, I'm happy to make sure. Have the research happen on that.
No, I never published that paper because I'm still looking for more impact. I mean, still trying to find it. But the point is, there is an issue here in the way.
You can't publish a paper which says there is no impact.
No, I'm not convinced there is no impact myself. I think there is. It's just that I can't.
But yeah, no, it's just going to go around the room. I think we'll go to Dr. Chandrasekhar, then we'll just go in this order. Anita, I'll come to you last because we're going around this room.
So I know this is a conference on the economics of DPI, but I just thought I will also mention that while these debates about costs and monopolies and contestability and all that is going on, there are some other dimensions also which are at work here and which need to be kept in mind. Because even if all the costs remain the same and everything remains the same, convenience might be one factor. I don't know how that will be brought into the calculus and how that would actually be factored in. The second is time as a dimension, not just the convenience, but the time it takes. And we are seeing that one is, at one level it is the transaction itself, whether it is quick commerce versus traditional e-commerce, or whether it is digital payments versus the traditional one. But the other deeper time factor is how markets and behavior change over what time frame. Because there might be one kind of an impact over a short time frame. People may actually be rooting for the convenience. But we know that in the digital world, the tech companies are always looking for a way to find a lock, which is a technology lock, not an economic lock. It's not a monopoly of the market or anything, but it's a technology lock. And the only thing that keeps us safe today is that there are several guys doing that, and hopefully they are competing with each other even at that level. So I think these are factors also which somewhere need to be kept in mind when you're dealing with the technology world, because that's how those guys think, and they know that it's not just economics, but there are a lot of issues relating to technology standards and so on. I thought I'd just flag those.
Thank you for that. I just want to point out a study done before UPI on the cost of cash in India. Rama Bijapurkar, somebody from Tufts University and so on, which talked about how much time an average person spends to go withdraw cash from an ATM, hours a month and so on. And it's I haven't seen anything done after that, and so it's very important to make sure we get these studies so that we have comparison of before, after, and all of those, and how the world has changed. The other one is in terms of inclusion. I think a lot of our, the Zildar CEO saying that because of Aadhaar and reduced KYC costs and reduced transaction costs, the number of people transacting in the stock market has gone up. So that the number of accounts, so DMATs, etc., has gone up just because the KYC cost has dropped, and so has the transaction cost because of UPI. And so those are, I think, some examples of where we can see changes in behavior measured by publicly available numbers, also attributed back to DPI. Is that a net economic benefit? I don't know, but is that, has that change happened? I think the answer to that would be yes.
I'll just spend a second on this. It's extremely important to figure this one out. Because is it just the delta, is there an improvement, or they're just eating into something else? Extremely critical.
No, even eating into something else is also okay. It's a public choice, right?
But for policy, it's really important to figure out where exactly do you want to
Harish, so I'd recommend that we increase the definition of DPI to also include use cases. Because if you only do DPI, you might not have the end nodes. I think we start to look at a use case as an example of KYC, the use case to stock trading or get into a bank account or something else. That might change the equation. So I'm just saying that look at the end use as well, because the end use is facilitated by the DPI.
That's why I was talking about the scenario. What would have been the outcome if we had gone another path and evaluate those outcomes?
No, counterfactuals are important, I agree. Just want to go around the room, just moving in that order, so I think we'll go there.
Thank you. And
my questions are actually related to the points raised by these two gentlemen. And the thought that comes into my mind first, being a technologist, is what is exactly the definition of the goal that we have set up for certain DPIs, right? And how do we define the impact of or the success of those DPIs? If UPI was designed, the design goal of the UPI was to eliminate cash, why has the cash at an all-time high in the society right now? And what is the role of institutions or the governments to ensure the adoption of the UPI? So for example, if demonetization would not have happened, would UPI be as popular as it is currently? Or if the government would not have pushed for Aadhaar, would it have gained traction, especially after the Supreme Court order, etc.? Those are some of the questions I think that we should also think when we are talking about the DPIs, what are the impacts that they are generating, and how we are looking at the various use cases that we have thought for. Another example could be, why is DigiLocker not gaining as much traction as UPI has gained or Aadhaar has gained? Is it because the institutions are not as keen, or is it the public who does not actually need a solution like DigiLocker? Those are some of the points that we also think about probably.
Great points.
A couple of related stray thoughts, I think, just from there is that when you were talking in the beginning about entry barriers being lowered because of availability of public infrastructure and open infrastructure rails, I was wondering if there is a role of policy choices that the government makes along with this, in the sense if you're looking at UPI, the choice of not having an MDR, or whether making it mandatory or voluntary, or how was it supposed to be financed. All of these have some consequences on the ultimate market structure. So while we are looking at the technology provisions that open up a market, the policy choices that the government makes, which is a part of the institutional design, will also have a bearing on the market structures. For example, if it was mandatory, all banks had to participate and it wasn't a choice, would that mean a very different looking market today? And that, or in the sense, if there was MDR, would we have more participants than less participants? If the financing was different, and there was sharing of costs in a different way, would it look different? So just not the infrastructure, but the policy choices with which a DPI is launched or designed, I think also has a huge bearing on the market outcomes. And just related
Actually,
to
that, can we just pause for a minute?
Yeah.
Some of these things change with time, right? Because when the thing comes into being, it has certain structure, certain choices, certain experiences, and regulations and policy change over time. I mean, so particularly MDR actually went to zero, and not by caused by NPCI, but caused by the union government, right? So there are these choices, and then the RBI decisions over time based on what they see. So it's a continuous process.
Yeah, I'm not picking stakeholders or timeline. I'm just saying from a research perspective or an outcome perspective, it is important that we also look at the policy choices that are determining the outcome.
I was actually pointing to the interesting thing was to say that you do get these epochs where you have a chance to study before and after.
Yeah.
So because things change over time, you can say, okay, what was it before zero MDR, what is it after zero MDR?
Okay.
Right? I was actually, sorry, I didn't mean to.
I don't think we disagree. And there was another, a very related micro point on, whether we're talking about new markets or we're talking about expansion of existing markets. Because, when we're talking about the fintech or we're talking about payment companies, are they competing in a market that's very different from banks and their net banking and payment solutions? Or are they a part of the same market? And from a competition analysis, at some point that becomes important. So just in terms of how you're defining the market is also one of the questions when you're looking at competition.
So just adding more questions, not answers. Even before we start thinking about the impact of DPI, I think we need to, it's going to be tough, but we need to figure out the boundaries of DPI. And it's going to be important for a couple of reasons. So DPI doesn't exist in isolation. I need broadband. Should broadband be considered DPI? Should Jio provide it? Should MTNL? If MTNL could provide it, everybody would have access to low-cost internet. It took a Geo, maybe driven by perverse, selfish profit motives, to take low-cost 4G to every nook and corner of the country. The reason it's important is, as Sir said, UPI disrupted Paytm. Okay, so if we don't define DPI, the boundaries of DPI, as a private fintech player, I may be worried that tomorrow a new DPI may come in that will completely disrupt my model. So I'm a Paytm, my wallet is disrupted. I start monetizing by offering credit. Now you offer a ULI, which may encourage innovation because it allows new entrants to come in, but it may also disrupt the lending model that Paytm and Google Pay and PhonePe are building. So on one hand, you are building capacity, underwriting cost of technology that encourages more entry, more competition. On the other hand, you're also stifling innovation by creating uncertainty, whether my business model gets disrupted, is there going to be excessive competition. The second point is, is it really leading to economic growth, or is it substitution between informal to formal? So informal economy is becoming formal, which may itself be of value. The challenge in studying all of this has been, there is hardly any data available. If NPCI doesn't make data available, we have been trying to get data from them for 3 years. Professors have got it by the way. We sitting in India did not. So if data becomes available, that allows us to do research. In the absence of data, we can speculate. So maybe if you all can encourage regulators and policymakers to work closely with researchers, do pilots, generate data, pivot if things are not working out, that will help a lot.
I actually want to contest the first point about, there is no certainty in the business world. I mean, if Paytm is disrupted by UPI, it could have been disrupted by PhonePe, which also had a wallet, or by other models. The wallet model as a licensed model was an interesting one that was there, and but it could have been disrupted by anything else. And businesses always have to worry about being disrupted by other businesses anyway. So, if something is happening in the public sphere, that is less of a concern, at least in my view, because startups should and take into account all kinds of disruptions coming in their way. But and I would not want that to be, at least my personal view, a public policy imperative is to prevent disruptions in the market, right? So I would want to encourage more disruptions. But coming to your point on data availability, I think that's something which we should figure out how we can get more of the research happening in India on this. And if there is something, we can try and see how we can facilitate that with more conversations. I think there are people in the room who can help with those conversations as well.
Just one more point. Yes, we should encourage disruption. The point is that we need disruption is a means to an end. The means is to promote more inclusion, more innovation, more competition. If the disruption ends up hurting innovation itself, and the reason is a PhonePe can compete with Paytm and it can disrupt Paytm, that is fine. Here, the cost of infrastructure is being underwritten by the government. So there is no profit motive.
Not the government. NPCI is not government. I think people assume it is. I want to be very clear.
But the MDR charges, being under the fact that there are zero MDR, that part is being subsidized by the government. PhonePe will not be doing that. So there is a profit motive angle that the DPI brings in, which the private sectors will care about.
Good research topics.
Hi. So we at IT for Change have actually worked on something recently that I think might be of relevance to the discussion we are having here. So we've actually been trying to sort of understand some of our recent work about the publicness of DPI. I think people brought up the point about digital public infrastructure. I think the analogy you drew, I think, was very interesting. I think there are probably a few foundational questions that we should think about before we think about questions of economics. And I think the first question here has to be about, I think, the state's intention with DPI. And I think one thing that we talk about often here at IDFC also is about a public innovation agenda. I think creating infrastructure layers or creating, so like a common example that we often get is the comparison between DPIs and railways. We often hear about railways providing these rails where people can access different goods and services and all. And if that is really the metaphor we want to take forward with, I think then there is importance to understand who gains from these railway lines that we are putting down, right? I think the point about data monetization now. So in the UPI case, although the existence of the UPI protocol has created a duopoly or oligopoly, the returns are from the monetization of the data that would occur. So the public innovation agenda here will have to consider how sensitive the data is in that particular ecosystem, how it sort of is accessible to researchers and other practitioners who conduct R&D to provide better suggestions, but not to private players to probably gatekeep and sort of scale ahead with it. Similarly, I would say one thing that we often talk about different sectors and different activities. I think that was a point that you brought up. I think there's also some value maybe in looking at the different DPIs we've had, not as like I would say completely disconnected innovations or completely disconnected interventions, but also like a journey, right? I mean, we figured out things in ABDM which we had not figured out by UPI. We figured out things through ONDC which we had not figured out through ABDM. So there is probably value now to compile learnings about what works in certain contexts and what doesn't, and move towards like a more broader agenda. I'm not sure if the Digital India Act is the right place to talk about stuff like this, but there has to be some larger consultation on what exactly does public innovation mean. Because is it DPI? We created the V map on DPI to further provide a model to private players to create on top of it, right? That was a good example of public innovation. We created a template model. So I think discussing a little more on what exactly do we mean by public innovation here and what's the public aspect of it, both in terms of what is the purpose the infrastructure is serving, but also how is the infrastructure controlled. I think these are two foundational questions that I think we should definitely
I think there's a session today in terms of the role of the state in DPI. I think it's a great topic for conversation there. Thank you for raising it, and we are setting ourselves up for lots of these conversations. And I think as we opened up, the point is all of this stuff is happening in India. It's good for it to be documented. It's good for it to be studied, to understand the path from innovation to impact. What are the mechanisms of transmission? Is it through reduced cost, increased participation, etc.? All of those factors would be great to have. The outcome from today should be that people sort of signing up to saying, I want to do research on X, right? And whatever question might come up. So it's wonderful to hear these things. Shall we go around the room? Anybody else? Anita is there? Anybody else? No, we still have Anita here, who's had raised her hand earlier. I said we'll come around.
5 minutes.
And 5 minutes. Okay.
Yeah, so I'll go here. So I think my question is relating to some points others, Mansi was making and others were making. So I, as an IT person, I want to understand, is there an economic model which can say that if you want your DPI to be a success, these are the parameters which should be available? Because in India, contrary to what I heard on the economic value, I perceive it and I hear everybody that it's a success. They say if India's UPI model is a success, or the payment infrastructure is a success. In a country we have a similar robust infrastructure, but it's not taking off. We are not seeing the exponential curve in number of transactions. So what is it? What is the secret recipe? What are the essential ingredients? What are optional ingredients? Is it possible to tell whether MDR is the issue, or is it government policy, or is it public awareness? So for me, these are some open questions. What can it lead for the DPI to be a success?
Okay. You'll have the last question.
It's not a question, more a reflection. And thinking about the market structures, I reflected on the layers. So public infrastructure and private innovation, or let's say more broadly innovation. And therefore thinking about market structures in these two different layers takes me to very different archetypes. So when I think of public innovation, I think of market structures which lend itself more towards essential services or more towards social protection. And when I think of the innovation, private or otherwise, that lends itself to a more classic definition of competition, market distortion, network effects, etc. And thinking further from there, and taking a few examples, when I think about financial services, where we have focused a lot of the attention, these are viable markets where a lot of use cases are viable for markets to exist. And because it's flow of money, it's flow of capital, whether it's stock markets, whether it's banking, whether it's credit, and therefore makes markets feasible, possible, thriving, greater degrees of competition law to be assessed. When we think of certain sectors, say agriculture, where market structures have evolved over time and sometimes markets are not viable. So information provisioning, for example, we have seen the graveyard of enough and more startups
trying to provide information in ways that can create viable business models haven't worked. However, in the case of when there is public infrastructure, provisioning of that information becomes possible. Jury is still divided on whether viable markets are possible on top of that or not. And the third example is in the case of telecom, where we saw a complete distortion, change, shift in structure, whatever you call it. But the complete dynamic of the market changed with the advent of eKYC, or the possibility of a quick onboarding of the customer, taking into account the regulatory requirement that you have to identify and verify who the individual signing up is. And that led to a primarily two-player plus a public entity driving the telecom market at high costs to a situation where in the short period of time, the complete market structure changed, but tremendous consumer value was created and several positive externalities related to reduced cost of data and therefore greater access. So bottom line being, across these three sectors which I've handpicked and which kind of reflected upon, different archetypes of market structures being shaped by public infrastructure show up and lead to very different types of questions related to how we should think about economics, how we should think about regulation and competition policy as well.
Thank you for that very robust discussion. And I think, many points have come about, these points of inflection in the last 8-10 years of this journey, which I think give us great data points of before and after, so we can have these studies to sort of figure out what was before, what's after, how did it change, what's the causality. I'm sure all of the questions, as long as data is available, and we'll have to figure out how to find that data, and maybe, but it's a great conversation.
And we're going to need some cross-sectional variation, not just time variation, if we actually want to have an identification strategy that'll pass muster in decent journals. Just one point that I wanted to make. There's several points that I'd like to add, but we've got the rest of the day for this. This is a reflection that someone was talking about increasing returns, and this is a reflection that CV Madhukar and I were doing. When you see prices going down, there can be two explanations for that. You can have decreasing returns to scale, and you have a downward sloping demand curve, and you simply have technological progress, and you have your upward sloping supply curve, which is a marginal cost curve. This is one of my thesis advisors, Paul Krugman, said, if you can't explain something with supply and demand, forget it, right? And so you just have shifting supply curve down a downward sloping demand curve. No market failure, no natural monopoly, no increasing returns. No need for state intervention. I mean, this is just technological progress. On the other hand, you could have a situation with a decreasing marginal cost curve, increasing returns to scale. In that case, you have a decreasing marginal cost curve, you have demand, downward sloping demand, which is shifting out, and observationally you see exactly the same thing. Do we actually know what the cost curves look like? Can someone give me the translog cost curve? Estimate, does this exist? By the way, this is a question that Nandan asked me. He said, do you have any evidence on this? And this is one of the reasons why we're setting up this conference.